Investment 360 in the Cape Town studio. With me is Piet Viljoen, who's a portfolio manager at local investment management company ReSea, and we're going to talk about emerging markets, Piet. And I've lost the plot completely, which is not unusual, but I've become so confused about whether emerging markets are underperforming, which ones are doing better than developed markets, because we had a horrible August, but things seem to have stabilised somewhat.
Yeah, so it's actually been quite a while now that emerging markets have been underperforming. I think on a 3-year view, they very far behind developed markets. We originally, about 3 years ago, when emerging markets were very popular and people were talking about all the growth coming out of emerging markets, we had a look at the valuations available there in the market, and they looked expensive to us. And we started avoiding, we didn't invest in emerging markets at all. And it's proven to be the right way to go, because over the past 3 years, they've massively underperformed developed markets, being Europe, being America, being Japan, that sort of thing.
Piet, valuations, I see you enthusiastic about local equities 3 years out. We could see the opportunity to get in, which I think a lot of people will be relieved to hear. Why are you going with that philosophy?
Well, I think one has to be careful when we say local equities. There are sectors of the local market that are very cheap. We think the resource sector is giving you almost a once-in-a-generation type of buying opportunity at this point. But there's not a lot outside of that. I mean, South Africa is an emerging market. We think emerging markets are still expensive. We think the expectations are still too high for emerging markets. And in our global funds, we're finding much more value in, as I said, Europe specifically, Japan, and even certain sectors in North America.
Piet, when you look at where you do find value, across the world, so in the different regions, are you finding that it's the same type of sectors that give you that value? In other words, when you look at, say, consumer in every sector, it's equally offering value? Or does the sector vary depending on the region of the world? In other words, can I buy a sector, or do I have to focus on buying a region?
Yeah, that's a very good question. There's certain sectoral similarities globally, and then there are certain differences. So one has to be very careful, as always, with investing. So broadly speaking, I think one can say that the cyclical resources sectors globally are looking fairly cheap, mainly because they can't pay dividends. And at this point in time, there's this willingness to pay almost any price for a stock that pays dividends. And so people are ignoring the latent valuation that's apparent in resource stocks. So that's one sector broadly in the world that is fairly cheap. But then within regions, like in Europe, we are finding in places like Portugal, Italy, Spain, we're finding retailers, France, we're finding retailers that are very, very cheap. And if you compare those retailers to, say, South African retailers, the valuation spread is just amazing. So we're buying food retailers in Portugal and in France, and we're avoiding them altogether in emerging markets like South Africa.
Piet, what about the approach, another approach? Is it the case that you look at individual stocks, individual companies, rather than regions? You're not going to say Rwanda is growing at 7.6% year on year, or Spain is suddenly coming out of recession, so I'm going to look at those countries. You're just simply looking at the companies, and it doesn't really matter in which emerging market they are.
That's right. So we look at companies from a bottom-up basis. We don't take broad geographic views. We don't take macroeconomic views. We don't bother with economic growth rates and interest rates. Those things are impossible to forecast, and people worry about them too much. We look at the underlying company valuations, and that's where the ideas come from. And we generally tend to get attracted to places where nobody else wants to be, because that's where you find cheap assets. You don't find cheap assets where everybody's sitting around the campfire holding hands singing Kumbaya. You find cheap assets where people are scared. So up until fairly recently, and still at the moment, people are scared about Europe because of all the obvious reasons. So we're finding quite interesting assets there, in the retail space, for instance.
Piet, can I ask you about the US market on that same basis? In other words, if you drill down into the various stocks on the US market, are you finding any difference relative to European shares? Obviously, the performance has been quite different. Is it a question of looking for smaller domestic type stocks within the US, or is it still the big multinationals?
Yeah, again, that's a bit of a broad brushstroke for us. I don't even know what are the biggest stocks in the US. We don't look at the index. We have no idea what is the biggest stock or the second biggest stock in the index. What we do look at is where the cheap opportunities are. So what we are finding in the US is that the oil companies, the oil majors, seem to us to be all quite cheap. You're buying companies like ExxonMobil and those sort of things on low PEs, which are generally not available at those sort of levels unless there's some sort of dislocation in the market like we're seeing right now. So we're seeing that sort of thing, and then also smaller companies. So again, it's hard to specify sector or size. It's the opportunities are from the bottom up, broadly speaking.
So Pete, the economist sitting next to me is feeling a little battered and bruised that you disregard economics to the extent that you do. Let's look at the opportunities in the South African space that you're excited about from an equity perspective right now. I think that also gives colour to the discussion.
Yeah, I think so. If I can just preface what I'm saying by making the point that I think in markets, history never repeats, but it rhymes. And I think what we're seeing today in Africa, in South Africa, specifically in Africa generally, is this widespread hope for high growth and accessing that growth through the listed stock markets. And we think that hope is misplaced. I think just to understand why, you have to rewind 10 years. 10 years ago, the very same people who are now trying to sell Africa to you were selling London and New York to you. And they were telling you to get out of Africa, get out of South Africa as quickly as you could and move your money offshore. Today, those same people are telling you, you've got to buy Africa because there's growth. I think one does exactly the opposite of that advice, generally speaking. So we are seeing the opportunities in Europe, not in Africa generally, and South Africa specifically, except for the one sector where people are scared, and that is the resource sector.
You're going to be unpopular with lots of people that come on this show because the African story is a theme on CNBC.
It is, very
and so
much
it should be. But that's not your investment philosophy.
Yeah.
Would you consider going into a company that is based, for example, in the developed world but gets 63% of its earnings from the emerging markets? Would you consider that to be an emerging market investment?
Well, again, that's a difficult one. I mean, we had fairly large exposure to a company called Coca-Cola Hellenic Bottling 2 or 3 years ago, which was a Coca-Cola bottling company listed in Athens, Greece. And when there were riots in Greece and everything, we went there. Our analysts were actually in Greece while the riots were going on. And they found this company, which its biggest operations were in Nigeria and Russia. But because it was listed in Athens, it was being thrown out, baby with the bathwater sort of stuff. And so we got quite a significant exposure to that stock at that time. So for us, that was an emerging market play available at distressed developed market valuations because of the circumstances in which it was listed. Subsequent to that, now it's moved its listing to London, and people realize, it's now Africa play and a Russia play and all that. So it's gotten expensive again, and we don't own it anymore.
I'm going to test an individual stock with you now, Pete. We were discussing Able earlier, obviously with the results out and the rights issue. Now at 13.14 rand, boosted its balance sheet, looking to dispose of Ellerines, which will further put more money into its coffers. Your thoughts on the stock at current levels?
Well, I have to say, I was watching your interview with Leon Kokinis earlier, and it was quite honest. I mean, he was quite open and honest about the mistakes they made and everything. So I think that's step one towards recovery. If a CEO can be that honest on TV, then I think they're on their way to recovery. So that for me is very positive. I think it's widely accepted that the company has made some mistakes. I think that's in the price. So we have become interested in that broad sector because of the fallout that's happened there. It's a company we're looking at very closely. We don't own it as such yet, but I think it's very interesting. And I think a lot of people will be waiting for it to have turned the corner to show you that it's now improving, that it's improved its operations. But I think that's going to be too late. I think one needs to make up your mind before that happens. One only has to look at what's happened to the platinum stocks over the past 6 months. They've just about doubled. And there's been no good news. The good news is only now starting to come out. So one has to be very careful about what you look for to tell you that it's time to invest. And I think news flow is not one of those things. I think you need to look at what you think the company is worth. And if the price is far enough below that, well, then you're being paid for the risk of a whole bunch of uncertainties, which they need to deal with every day today.
Pitt, can we just drill down a
So
little
that's a
bit?
long-winded way of saying I don't know yet.
Pitt, can we drill down a little bit into our resource sector? Early on you said you don't really like the South African market, but you do like an element of the resource sector.
Yes.
Within that, can you be more specific about any particular companies that you're focusing on now?
Yeah. Yes, I can. I think our biggest holding is Amplats, both in our local funds and in our global fund. We think Amplats is probably the best platinum company in the world, which is why it's number one holding in our global fund as well. And it's extremely cheap. It is trading at, not as much now as, say, 6 months or a year ago, but it continues to trade at depressed valuations, and we think it's a 40 to 50 year life asset. In other words, it's going to be around 40 or 50 years. And who knows what the environment is going to be like in 3 or 4 years. And remember, 5 years ago when everyone was bullish about the stock, where are we today? So we can't forecast those sort of things. So we have to look at the long lifespan and discount those today back to today's levels, and we think you're getting a lot more than you're paying for it.
Just quickly on the one last point about the platinum sector and the stock you've mentioned, the company you've mentioned. Is it too late to get in? People will be saying, well, it's doubled anyway, so I mean, it's too late now. Is there more to come?
Well, we don't know if there's more to come, but it's still not expensive. So the returns aren't super good, but according to us, they'll still be good.
Okay.